end of last year. It wasn't at a pace that we, go home and pop the champagne corks for, but it was steady. And in fact, we had a couple of good quarters coming into this thing. Again, backward looking data, but shows you where we were before kind of the March ramp up. When you think about it in terms of jobs, you see the same thing. And in fact, you can see here some of the stuff that I mentioned early on, which is that job growth was actually ramping up leading into this thing. We weren't just maintaining job growth, but actually January, February, even December, we were seeing that curve start to trend upward. We were gaining momentum both nationwide and more specifically here in California. 1.6% again isn't a huge number in terms of job growth rates. It's nothing to write home about, obviously, but in the context of an economy that was essentially at all-time low levels for unemployment, growing, still being able to expand the job base at almost 2% on an annualized basis is pretty remarkable, given that all of the unemployment that we do have, or that we did have, was largely structural, right? We had people who didn't have the right skills for the jobs that were in places where they didn't have the right people, not because there was a bunch of people on the sidelines who wanted jobs and couldn't get them. And so again, we were on a pretty strong footing. And I think this is the tale of the tape of the kind of pre-March 2020 housing crisis, right? Because, yes, during the last downturn, we lost about 1.3 million jobs between 2007 and 2010, but we had actually added back all of those jobs by 2014. And over the last 6 years, pretty much every month was a new all-time high level for jobs, such that, by February 2020, we were like 2.1 million, jobs higher than we were even at the peak of the last, cycle back in 2007. And so that was our huge fundamental strength as an economy, that we just continued to add high paying jobs and jobs across the spectrum of, wages and industries. I didn't bring the building permits numbers with me today, but you can rest assured that we did not add 2.1 million new housing units to California during that time, which is why we saw such robust price growth and low levels of vacancy, also low levels of housing affordability. When you think about it just from the general consumer standpoint, consumers are riding high as well. We weren't at all-time high levels of consumer confidence, but we were at decade high levels of consumer confidence, and folks were feeling pretty good. And that was showing up not just in their, in their feelings when you went out and took their temperature, but also in their spending, right? We were seeing spending go the same way that jobs were, all-time high numbers of people working, all-time high amounts of spending out in the economy. And you could see again in the December, January period, we weren't just maintaining growth, we actually were seeing growth start to ramp up. So again, 2020 was shaping up to be a pretty good year, both in the general economy and in the housing market specifically. And I think we saw that in our closed sales for January, February, and in price growth, frankly. And one of the main reasons that I'm more optimistic about the recovery this time is because of this indicator right here. We're looking at debt and just more general financial obligations, both measured as a percentage of income. And what you could see is that, yes, partly aided by such historically low interest rates, but debt was not the key issue in our economy as it was back in 2007, 8, 9, where we had these fundamental imbalances. People had more financial obligations than they could afford. And it was these internal issues that kind of sunk the ship, if you will, versus this is kind of an external threat happening to an otherwise fairly robust economy from both a household and a corporate balance sheet standpoint. So we were in good shape. I do think that the market was already looking for a reason to correct. So if you go back to last year, we were already, reading news stories like the yield curve inverted, or we're in the midst of the longest expansion in history. So something's got to happen. People were in a kind of waiting for the other shoe to drop, or waiting to be nudged towards a correction. I think that also the financial markets were a little bit frothy. So if you do a PE ratio, not for an individual company, but for the whole entire US economy, by looking at the value of all publicly traded stocks and then dividing out the amount of corporate profits that those firms are generating, you can see that valuations were getting a little bit ahead of of earnings, certainly not to all-time high levels. But again, I do think that the market was frothy, and with rates as low as they were, it was like real estate or the stock market was the only game in town if you had some dough to sock away. And so I think that inherently pumps up the market, and they were looking for that nudge. Unfortunately, we got this kind of giant sudden shove in the form of coronavirus, and that's why I think we need to take this seriously, not just because of what's happened in the stock market. And yes, you could see here, even with the recent rally over the last 2 weeks to about 24,000 on the Dow, we've still wiped out essentially like 2.5 years. It was, 3.5 to 4 years of financial market gains, but we're still wiped out about 2 years worth of financial market gains. And that impacts people's wealth, obviously, which has direct implications for us in the housing market, particularly, in LA and over by the beach and things like that, where people are cashing in on their company's IPO or their shares that they got out of their company or what have you to sometimes purchase homes. And so you'll see the wealth implications in there. In fact, wealth and the average wealth of the typical household out there. So when we measure real net worth on a per capita basis, this strips away inflation. But this is one of the few indicators, and you can see it here, these gray bars represent recessions. This is one of the few economic indicators out there that's batting 1,000 in terms of actually predicting a recession. So when we think about those stock market gains, people will, or the losses rather that we've seen over the course of the last month and a half, that will result in a population that is on average poorer than we were going into this. And that suggests that the economy is going to have a tough time. You're not out there buying cars and going out to eat as much, even once the shelter in place gets lifted, if you're feeling much more poor than you were a month ago. The other reason is because consumer confidence matters, right? So when those financial markets go down and consumer confidence is impacted, that impacts the economy as a whole. So what I'm showing you right here is the GDP numbers that I showed you earlier. This time I'm breaking it out by how much was consumer spending versus every other part of our economy: business investment, government spending, international trade, et cetera. And what you can see is that, consumers were largely carrying this economy on their backs for the better part of the last, 3 to 4 years. It's been at least 70 to 80% of all economic growth has been generated by consumer spending. And so not only are people going to feel poor, right? And that's going to have implications, but we don't have a lot to fall back on. A lot of our economic eggs, most of our economic eggs were in one basket, the basket that's likely to be the most impacted, both because we're seeing all these job losses and the shelter in place, and then obviously the wealth effects that I talked about earlier. And lo and behold, when the March consumer sentiment numbers came out, we saw that it had retrenched basically in the single largest decline that we've seen since the financial crisis back in 2008. So this is impacting folks, and in fact, we see it showing up in the retail sales numbers, which these are very backward looking to February. And so for me, this is a real bellwether, right? Because February was, again, a lifetime ago in terms of the coronavirus. Only really the last week of February was impacted, if at all, honestly. And so for that last week to have been negative enough to drag down the whole month of what was otherwise a good February, that suggests that when the dust settles and we get this data, that March and April are going to be pretty severely impacted from a consumer spending standpoint, which again was all we have to grow the economy on, which is why we're seeing these big negative forecasts for Q2 GDP coming down the pike. And I won't beat these to death. I can email these to Tara or Laura or whatever for you guys to have. But I just brought all these different examples of how we're seeing that play out across the economy, right? Nobody's going to the movies. Nobody's over at Pantages taking in a show, right? We're not seeing any Laker games, and then my colleague Oscar is devastated on an emotional level for that, but it's also having economic impacts, right? Because we don't have all those people out at LA Live and spending money, et cetera, et cetera. Restaurants, hotels, grocery delivery is the one area that has kind of benefited from an online renaissance, if you will, but that hasn't filtered over to restaurant, meal deliveries, and that forms the lion's share, unfortunately, of the employment in the food service sector, obviously. And so, not a great time to be in the hotel or conference event business, right? And we see the same thing in terms of flight numbers, just not a lot of people unless you absolutely have to take in flights. And so this is where the rubber kind of meets the road on all that economic nerdy data, right? Is that we have seen over the last 3 weeks, over 17 million people file for unemployment insurance, which is off the charts. And we've never seen this big of a ramp up. To put that in perspective, you can see I've called out the financial crisis of 2008 for you there. And over a 2-year period, we had about 37 million new claims for unemployment insurance. And we've basically achieved about half that level in just 3 weeks' time. So really, again, this is what makes my job pretty difficult as an economic forecaster. What historical period do we go back and look at to try and inform on what the next 12 to 18 months is going to look like when you have charts like this that basically don't even register on a normal axis. In fact, I think the best visual of this was in the New York Times the other day when they had to take away the whole right column of the front page just to be able to show in perspective. And so this is what really matters for us, right? Because when people aren't out there earning money, then that obviously has implications for them paying their rent, purchasing a home, et cetera. And so we see this already really playing out over the expectations for real estate very quickly. So we've started very early on, the first week of March, we started surveying realtors to get a sense of how this was impacting their business. And we've been doing so for the last 6 weeks. And what you could see is that, over the first 3 weeks of March, we basically went from a situation where roughly half realtors were expecting this to have some kind of a negative impact on their business to, for the last 4 weeks running, including the survey we just ran over the weekend, which closed on the 13th, which I believe is yesterday. Yeah. We've gone to basically a plurality of everybody expecting to have negative impacts on their business, at least realtors, where it's more evident, I guess, or where it's going to be more impactful, at least to our pocketbooks, is that buyers are showing cold feet, right? So for the last 4 weeks in a row, we've had between a third and 44% of realtors have actually experienced not just buyers getting cold feet. So we did actually ask a buyer cold feet question, and the percentage there was much higher, like 78% of realtors have buyers who are kind of wishy-washy, dragging their feet, but 44% had actually had a buyer withdraw an offer formally, right? And so importantly, that's not zero. There's still buyers moving forward, right? More than half did not withdraw an offer, obviously, but 44% withdrawing is going to have implications. And one of the biggest reasons, yes, we're seeing the kind of cold foot effect baked into these numbers, but we're also just seeing a financing issue, right? Where people have all of a sudden lost jobs and had to pull back offers and things like that, or had, we're going off stated income and those loans have now dried up, et cetera. And so there's a lot of issues that folks are encountering in the escrow process, and also just with people losing the wherewithal. And we're seeing similar numbers, in fact, a little bit higher on the sell side, where again, not only were sellers worried or kind of feeling hesitant about selling their home, we've actually had more than half of members, and this is between 700 and 1,000 that we're talking to every week. More than half have actually had a seller pull their home down off of the MLS and go into a wait and see mode. And so again, this means less inventory out there and potentially less buyers. I think from a price standpoint, the fact that listings are impacted more than buyer demand, it will help to prevent prices from seeing the kind of declines that we had when we had real internal problems. But we have to be really on our A game, and our clients need us now more than ever, because we've actually had almost 30% of realtors have had a transaction fall out, whether that was because of people backing out or because of financing issues that they encountered or appraisals, not being able to get done, and just all kinds of issues that are happening. These are things that we're going to need to be, again, on our game for, because again, our clients are going to need us more than ever. And unfortunately, I think that the forecast is for the environment to remain pretty challenging while the shelter in place is still happening, right? And so the other thing that we've started to do, in addition to surveying realtors every week, is we've actually started going into the MLS, every MLS, or actually I should say about 2/3 of MLSs, every single night, to get a sense of just how much is closing, how much is being listed and pending uh, every day. And so this is some average daily close numbers. In fact, I think I brought a better chart. Maybe I didn't. Let me see. Yeah, so here's like all of Southern California, and what you could see is that closed sales have definitely been impacted if you go back over the last 6 weeks. So like Southern California, we were closing on average 3,200 sales a week back before the shelter in place. And then from the 16th of March onward, we've seen that decline. Now, we don't want to overinterpret the kind of week 5 numbers that just ended on Friday. Some of the closings haven't actually been entered into the MLS yet, right? So I expect that to grow a little bit, but you can clearly see a downtrend of about 800 or so closed transactions. And I know I'm calling it new listings here. I'll fix this on the thing. These are actually closed, but what you can see is that we are down about 25 to 35%, depending on the area. New listings were down a lot as well. So there was double-digit declines in the amount of actually active inventory out there. And the bigger one where you can see the most effect is on pendings, right? So we're just not seeing as much pending. In fact, this week we're going to put out our March press release for the March 2020 entire month-long housing market numbers. And the numbers don't look that bad for March. And I think partly, sales were holding up better than listings and pendings, as I just showed you. We didn't really see those closed sales fall off until the first couple of weeks of April, but that's largely because of all the sales that went pending back in January and February, right? And so those were the ones that were closing still through those first few weeks of March. And I think that we will start to see pendings, which have gone down by about 50% or so across the state, start to play themselves out in terms of closed sales, right? So we can expect that the market will remain tight, and you can see that translated into a percentage basis that we're still seeing basically double-digit declines in what's going pending. So we're not seeing 100% decline. So again, I want to underscore that the business is still getting done and people are finding a way to operate remotely. There's still people in the market who have to buy and sell or just want to. Rates again are very low, and so but that being said, the number of closed transactions will be substantially lower than we were on course to set for 2020, right? So that's the bad news, right? That we're seeing kind of deep and unprecedented impacts across the macro economy in terms of spending, in terms of unemployment claims. We're seeing that play out in the mindsets of realtors, right? Where everybody's expecting negative impacts for their business. And lo and behold, when we log into the MLS on a daily basis, we're actually seeing fewer closed sales, but more importantly, fewer pending and new listings coming online that are going to have direct pocketbook implications for us as realtors. That being said, I think it's important to point out that real estate should be one of the bright spots once we get past the outbreak, right? And I love bringing this kind of long-term history of almost over 50 years of interest rate data with me, right? Because in the latest weekly data, we had about a 3.3. I think 2 days ago on the daily stuff, we even got down to 3.25 on a 30-year fixed rate mortgage. And that's pretty remarkable, coming from a guy whose dad used to drag him around at his business parties in the 80s bragging about his 12.5% mortgage interest rate. We are in a very historically low rate environment, and that will be a feather in the cap for us once people are actually able to kind of enter a recovery mode. That's going to be a very attractive cost savings, especially here in California, where we have such high prices, and even little movements in interest rates have big implications for people's monthly payments. And I think that will be a specific benefit to us in housing in particular. The other thing I'd point out is that we might see rates go even lower than they are right now, right? If you look at spreads between the 30-year fixed rate mortgage rate and 10-year treasuries, typically the spread on that is something on the order of about 170 basis points, or 1.7 percentage points, that you would just add on to the 10-year bond rate, right? And more often than not, you are going to be right just by simply making that simple addition. Now we're running a spread of almost 300 basis points, right? And that suggests that, and there's all kinds of frictions. And if we have time for a Q&A, we can nerd out on all the financial market frictions that I think are preventing these low rates, these low treasury rates, from benefiting housing consumers fully yet, including, the issues on servicing and MBS liquidity and all that stuff. But the point remains that I think that stuff will eventually work itself out, and we'll have a functioning credit market again in relatively short order, and that will mean that we have lower mortgage rates even than what we see right now, right? And so again, that's going to be an even bigger wind in the sails of housing as we move forward. The other thing I would point out is that, yes, we've seen the market stabilize around 23,000 or so over the course of the last week or so. But I think that there's still a lot of volatility that we can expect in financial markets. And I think that from the perspective of an investor who expects the markets to remain volatile, right, that real estate remains attractive investment, right? And so I think that we'll see more of that later. I think we're even starting to see some of that now, where people want to park money in real estate to avoid, more wobbles on financial markets. But I think that, over the recovery period, housing will also be attractive for folks to jump back into as well. And I'll just remind folks that, we did have a really strong market coming into this thing. Again, the February 2020 sales numbers seem like a lifetime ago, but right before the onset of this thing, we were growing closed transactions by 6%. We were up 8% over the first 2 months of 2019, when actually early 2019, if you can remember back then, we were looking at almost 5% mortgage rates, right? And so we were having, 3.5% mortgage rates or so at the beginning of this year, and things were really starting to ramp up. We actually saw home prices start to accelerate through February as well. That's not going to save us, right, from these negative impacts, but we did see prices ramping up to basically on track for another all-time high for 2020. So from a forecasting standpoint, I think the technical number is this. But there's just a lot of uncertainty out there in terms of what's coming down the pike. We're not alone in not really being able to fully assess the impacts. Again, a lot of the data is backward looking, but if you look at the forecasts, they range from anywhere from the economy shrinking by about 9.5%, 10% at UBS. Ignore the UCLA number. That's a quarterly number. If you annualize that up, it's actually about 30%. But they range from a small of an impact as negative 10% in the second quarter of 2020, all the way up to a negative 50% as forecasted by the Atlanta Fed the St. Louis Fed, sorry. And pretty much everything in between. And these are all reputable shops, right? These aren't crackpot forecasters out there in their mom's basement or something like that. These are reputable forecasts that are all over the map. And so I think the big takeaway is focus on what you can do individually, because nobody really knows exactly what the numeric point estimate for the hit is going to be. And similarly on the recovery, right? If you look over at the column for the third quarter of 2020, you have some folks forecasting that the economy will continue to shrink in the third quarter. And then you've got other shops like Morgan Stanley or Goldman Sachs that expect a 20% snapback in the economy as people rush out and start buying cars and spending money again in the third quarter, and again, everything in between. So lots of uncertainty about what the forecast looks like. We have had both the Fed and the federal government take pretty unprecedented steps, some of which benefit us as realtors, independent contractors, brokers, what have you, directly, in terms of forgivable small business loans, pandemic unemployment assistance, which here in California, they've absolutely struggled to roll out at the state level, unfortunately, and also stimulus checks and rebate checks, which have started to hit people's accounts as of this week. And so we've had some good first steps. I'll remind everyone that these things too, this too shall pass, right? If you look at historic outbreaks and pandemics like SARS or MERS, or even the natural disaster or whatever man-made disaster at Fukushima in Japan, the recovery proceeded over a period of months and not years, right? And so that should be a source of encouragement as well. And I would just point out that timing is really everything, right? You can see that even with the really strong assumptions of social distancing and all the other protective measures, that yes, we were able to avoid a kind of New York-esque scenario where we were going to completely bust through the available beds and have this humongous strain on our medical system. You can see down in early May, we're forecasted to hit the peak in terms of amount of beds that we need for ICU and ventilators that we'll just barely be able to meet the demand for. But even with really strong assumptions on social distancing, right, and us really flattening the curve and doing a great job, we're still looking at, early June as kind of a best case for being able to start to get over the hump in terms of meeting all the demands of the infection, which will continue on at least at some, much reduced, hopefully, level. And this is why social distancing is so important, right? If you can do, as we've done here in California, and do a really good job of flattening the curve, you can see that it's like a tenfold decrease versus doing a couple of weeks and then trying to rush back to normal too early. The projections, under that type of a scenario call for a tenfold increase in the amount of infection. So a little bit longer and more short-term pain, I think, will let us get to that ramp up recovery period sooner. And again, kind of taking the medicine now will help us be healthier, I think, that much sooner. And that's really what all of these projections are predicated on, right? Because if we do try and rush back to normal too soon, and instead of getting back, towards some form of, non-shelter in place by early June, but instead we're still, stuck at home in, September, October, God forbid, November, December, then I think the projections become much more grim in terms of the recovery period, right? As an employer, I can bring back jobs that I had to temporarily lay off for a period of 8 to 10 weeks. But if I've had to operate for 6 or 8 months, or maybe even shutter my business, right, then the prospects for bringing jobs right back online becomes much more tenuous. So again, the tougher we make it on ourselves right now might ultimately be just what the doctor ordered. If we can do that, I think we can make it look something like a Hurricane Katrina-esque type of event, right? Where we had this kind of huge impact to us virtually overnight with a fairly rapid period where we're able to chip back away at those unemployment claims and get folks back to work. But again, that's predicated on getting the virus under control. And I think that that's really why you see such a huge variation on those forecasts that I showed you earlier, not just ours. So I know I talked for a half hour or 40 minutes or whatever it was, but I wanted to leave time in case you guys had any questions. But I would just sum up by reminding you of the context, right? That 2020 was shaping up to be actually a great year economically and housing specific, right? But we did see that the virus has pretty much changed everything on that front. I showed you all those different charts that are pretty scary in terms of how unprecedented this is from an economic standpoint in terms of job loss and reductions in spending, of which is, the single largest source of economic growth. We still don't have a lot of good data to look at, but I did show you the stuff that we do have on unemployment, on consumer spending, and on these market impacts that we're tracking at C.A.R. on a day by day basis. And so those unemployment numbers in particular, I think, will drive negative impacts that we are already feeling in housing, both in terms of buyers having to take a step back and sellers pulling homes off the market. But business is still getting done. And I think that the key question for the recovery is just how long this shelter in place lasts. And again, the more we can batten down the hatches now is the quicker that we can get back to the recovery. And I think that the sooner we can truly be in recovery mode, the more robust the recovery will be. And I'm not a medical expert, so that's why I gave you the big question mark, but I gave you all the information, hopefully, that I am looking at to try and judge which way this thing is going. So we do have a lot of resources at C.A.R. for realtors. We have our coronavirus microsite, of which I've linked you down below, and we're updating that with information on a day by day, in fact, an hour by hour basis. I'm putting a new market update out there every week. I know you guys just got it from me here directly, but we also have a COVID relief hotline that we stood up to specifically be able to connect you one-on-one with one of our staff who can point in the direction of the various sources of assistance that the federal government has made available, be it the small business loans that are out there, or eventually, once the state gets their act together, the pandemic unemployment assistance, which is available for independent contractors. We've got new forms and all kinds of help with electronic closings, and we're working on the online notary services. And of course, you can still access any of the other resources that we've always had for you, including the legal hotline, where you can talk one-on-one with an attorney to help you get through a transaction rescue if you want to get through any of those more challenging finance issues that you're dealing with. And again, I'll just say thanks to Joey and Tara and Laura for reaching out and inviting me to be here with you today. And if I haven't beat you into submission, I'm happy to chat through questions.
Jordan, thank you so much. That was amazing. I'm gonna listen to it again and absorb as much more than I could in that moment. If anybody has any questions, could you please put them in the chat so we could keep it a little orderly, or it becomes a little bit of a pile on. So anyone who has any questions, please put it in the chat, and I will be more than happy to address them. Also, is there anything idiosyncratic about our market that we're missing at all?
No, I think, when I looked at the Southern California data and LA in particular, and we can even drill down, actually, I can even share screen and we can drill down. And I built this little dashboard that maybe you guys will find fun, that we can kind of drill down. Oops, I got it in a phone layout. Hold on, let me switch that off. But basically, I know
we looked at closed sales month to date, and we were at like 14 up to today. I think we were at like 1467 or something like that, like just below 1500. And last year was about month to date was about 2400. Yeah, so we're down about 45, which seems to be in line with the numbers that you're talking about all over California.
Yeah, exactly. So, I mean, we're seeing a lot of the same things. And I think, because LA is such a big part of California in general, right, that we kind of are the statewide number in a lot of ways. But we're very much hunkered down and in shelter in place mode. But I think, we're going to look pretty similar to what we see statewide, just because not a lot of activity on the open house traffic. Sure. The one thing that I will point out, if I can get there, is that we haven't seen a lot of price impacts. And I know that's one of the big questions that I get asked all the time, is like, what does this mean for prices though? Right. And so, if you actually look, the sales to list price is, or actually, here you go. Closed sale prices are down a little bit, but actually, if you divide it up on a per square foot basis, this chart over here, you can see that per square foot prices are not down very much. We went from about 330-ish bucks statewide down to about 323. So maybe $10 on a base of about 300. So not huge price impacts. And the other thing that gives me some solace, and again, these go through, I think yesterday, So yeah, if you look at the percentage of actives out there that have actually done a price reduction, you haven't seen this spike over the course of the last couple of weeks, right? We're pretty steady at basically about 1 out of 4 have reduced. And then over here on the right, you can see that the median reduction has gone from, of those 25% that have actually reduced, they've gone from reducing by about 3.9% kind of pre-COVID to a median reduction of about 4.3. So we're not seeing drastic
It's not huge.
price cuts. And I think that that's because, ultimately the sellers have taken more of a step back than the buyers, right? We've seen both downshift, but inventory on net has actually gotten tighter. And so the buyers that are out there have less to choose from. And that means still, there's no fire sales happening.
Yeah, this is like an interesting moment. It's the way I describe it, and correct me, this is like not a market. This is like ether before a market, right? It can't be defined as it's a singular moment, not a systemic pattern moving forward. Right now, I mean, what it turns into, we're using this information to judge, but right now there's not enough of an understanding of it. Yeah.
Totally. And I think that, low rates do help. There's some people out there who are secure in their jobs, and they're looking at low rates the way that my dad would have looked at a 3.25% mortgage rate. And it's like, time to go,
Yeah.
So.
Yeah. So I don't see any, did anyone have any, I mean, that was a lot of information, and I'm sure we're all digesting it, and we've recorded this so we can look at it again and distribute it to everyone. We know these charts are, you're already on it. So charts are emailed, the presentation in Zoom we've recorded, and we'll disseminate it to you guys and make that available. I know for myself, like I said, I want to listen to it one again. And if no one has anything else to ask, we'll let Jordan go and continue in his day. Thank you so much again, Jordan. It was perfect.
Awesome.
Perfect.
Hey,
lots
thanks
of
again
great
for having
information.
me back. Good luck.
You have a great day.
All right.
I will do. Thank you, sir. You have a great one. Thank you, Laura.
Thank you.
Thank you.